On behalf of Crosscheck Media and BizTalk Today TV, welcome everyone to the Money Path. I am your host, Todd Schoenberger. Joining me today is Ryan Detrick. He is the Chief Market Strategist at the Carson Group and also co-host of the Facts versus Feelings podcast. Ryan, you've been very bullish all year. No secret there. You've been beating the drum on this bull market and, to quote, buy weakness. What evidence convinces you, though, that that is the right path to still be on today?
Yeah, well, first off, thank you for having me, Todd. I appreciate the opportunity today. Yeah, we've been in that lonely camp. We've been bullish for several years. It wasn't always popular. Now I look around and people are a little more bullish. But look at just like 2 weeks ago, right? I mean, 2 weeks ago we had after a 38% rally in the S&P 500, we had a relatively modest 6% pullback. I get it. Technology is down more. Some of the high flyers are down more. I think that's what people are over leveraged and in a little too much, so they're feeling a little uncomfortable. But after that rally, we needed to shake the tree. We needed to kind of, get people a little less comfortable, right? And that's what happened. And that's what it shook out the weak hands. And then we had literally the third largest rally during a Thanksgiving week ever. And there's so many ways I can take this, but I've got my CMT right here. I'm a chartered market technician. Got my diploma right next to me.
Very
So
nice.
I look at the market based on kind of supply and demand, relative strength, market sentiment, and I definitely focus on fundamentals, the Fed, all that stuff. But the way I learned it, Todd, many years ago, market breadth leads price. Just last week, the S&P 500's advanced decline line, a cumulative basis, how many stocks going up versus down, hit an all-time high, right? I mean, to me, that says price is going to get there. All we hear is how bad market breadth is. I've been pushing back against that all year. I look around the globe, we've got just about every indice out there, every major country out there hitting all-time highs or 52-week highs. Market breadth isn't bad. In November, 8 of 11 sectors were higher by a good deal. Technology down 5%. Yes, we have extremely healthy market breadth when I look at things. All 11 sectors are higher, yada, yada, yada. I can keep going. I don't understand where this comes from, that only 7 stocks are going up. The Mag 7, or I'm sorry, the 493, so X Mag 7, there's an ETF, but I can't mention it because I'm not really allowed to mention individual equities, but there is an ETF you can find pretty fast. It's the 493. It literally closed at its highest level ever on a monthly basis just last month. So market breadth continues to be strong. I look at the last comment. I look at things like the credit markets. When everyone was freaking out this time 2 weeks ago, because the market had a 6% mild pullback, you had the VIX spike up around 30. That's been kind of a bullish signal. But look at high yield, okay? High yield bonds were barely down. They were like up a couple Thursdays ago, had that total bloodbath 2 Thursdays ago, the Thursday before Thanksgiving. High yield was up that day. And I looked at this saying, listen, if there's a monster under the bed, high yield would tell us. You know when we saw that before? During the Liberation Day, Obliteration Day. High yield hauled in there. During the sell-off in March of 2023, regional bank crisis, high yield hung in there. So if there's real worry, the credit markets would show it. We're not seeing that yet. So credit markets holding in there, market breadth strong, and sentiment, people just can't wait to get turned bearish. Those are 3 reasons that I still think this bull market's alive and well.
That's incredible. I mean, I've been watching you forever. I don't think I've ever heard you so optimistic right now on the markets. It's amazing. And that sentiment definitely carries over. But I have to ask, what would it take to convince you that maybe a pullback or maybe a pullback for being overweight equities is justified?
Yeah, well, good question there. I mean, once a year, on average, you see a 10% peak to trough correction, right? You see a bear market about every 3.5 years. You see a 3% minor dip 8 times a year. You see a 5%er 3 times a year on average. So you can have one of those for any reason. But what would really, truly worry us again is if I saw credit spreads starting to blow out a little bit more, which we're not. We're not seeing that. Triple B spreads, triple A spreads. We're not seeing that. But the credit markets would show us, I think, if something's really wrong structurally out there. And then, again, how many stocks are going up versus down. I mean, in the late 90s, we saw advanced decline lines peak and they started to roll over, even though the market was still going up, telling us there's something under the surface that's breaking, that's not working. And I love to look at sector leadership. Now, these are not your father's utilities, so I really wouldn't lump utilities here anymore. In a past life, I would have said utilities and staples. If you see relative strength from those two areas, that's the market's way of telling you something's wrong. People forget this. The fourth quarter of 21, when everybody got government money and everybody's gambling, and everybody's day trading and buying crypto, making all this money. The
Yeah.
fourth quarter of 21, like the strongest group, it was utilities, it was staples, it was low vol, telling us something is probably off here for that leadership to be coming from the weak, not weak, but the more defensive areas. And then we all know what happened. The market fell apart in 22. So we're simply not seeing that. But Todd, those are things I'm looking for that show there are cracks potentially under the surface.
So you were calling for a rally by year end, but we also should expect some choppiness in the first part of December. What is the catalyst that causes that switch to flip where we have the choppiness and then just a rally going into the end of the year?
Yeah, well, that's a great question there. I mean, there is a little bit of low volume. There is a little bit of the feel good time of the year. I mean, we saw it happen in November when there's not a lot of news. Late in the year, you get that upward bias. Also, you tend to have a Fed meeting around the middle of the month also, right? We've got a Fed
Right.
meeting next week, and we're going to talk more about that. So you can have some potential, just get that last bit of news out of the way. Earnings season's over. All that stuff's out of the way. But just a couple things that I've been working on. So December is up about 73% of the time. There's no month likely to be up more on average than or more higher on average than the month of December. We were down last December. Last December was kind of an ugly month at the end of a really good year. It's really, really rare for December to be down 2 years in a row. And to lay on top of this a little bit, I thought that's worked on this morning. It's kind of cool. If you go back 40 years, so we're in the first year of a 4-year presidential cycle. All right, go back 40 years. December has been higher 9 out of 10 times. When you're in, again, the first year of a presidential cycle like we are now, but up 5% for the year. So pretty good year, going into the last month, Todd. December's been higher every single time since World War II, 12 out of 12 times. Now, these are just seasonal stats. I get it. But I think the realization that this economy is pretty good. Earnings were just spectacular. Revenue for companies, that sell most of the revenue overseas, their earnings are up over double digits this most recent earnings season. I mean, things are really good out there. People keep telling us how bad they are. Now, I will say we manage almost $7 billion on our team. We're not just like all in on tech by no means. We're overweight equities, yes. But we have probably, for an RIA the size of us, we have probably more developed international than just about anybody. At the start of this year, we were saying we like developed international. We like Europe. We got some really weird looks when we said that. Fortunately, that's played out. So we like the U.S., yes. We like large caps, yes. But when in doubt, diversify it out. We own some emerging markets. We're underweight emerging markets a little bit. We like large over small. We still own small caps. We have managed futures. We've owned gold for over 2.5 years. When we started adding gold back in 23, people thought we were crazy then. There's ways you can diversify your portfolio to still benefit from this bull market. And those are ways to help you sleep at night versus going all in on the AI or the quantum trades and all that stuff. So when you have those 30 to 40% haircuts that happen, you don't freak out too much. And I think that's important for investors to remember.
So you brought it up, the Fed, they're
Yeah.
meeting next week. The decision is on the 10th, whether they're going to cut rates or not. Now the feeling on Wall Street is that they will be cutting rates, but do you think it's justified? Because everything you just said, it sounds like everything's great with the economy.
Yeah, there are some cracks in the labor market. You look at the labor market. I know some of the initial jobless claims have hung in there, but we know there's potentially some layoffs that have been coming. There are some cracks out there. And when we look at inflation, I mean, I know we haven't had inflation data for a while, but what we do know is like private data, right? Things like Zillow, right? Year over year rent prices are negative. Shelter makes up 43% of core CPI. So I know there are pockets out there of inflation. Yes, tariffs have caused a little bit higher prices with goods. We know that. But we still think inflation's fairly under control. So if you have a weakening labor market that maybe will continue to weaken, I'm not so sure you need interest rates up where they are. We've been saying all year the Fed should be cutting, and then they kind of were a little stubborn and didn't cut right ahead of start of this year. We thought they should have been cutting. Then they didn't. Then we had all the tariff stuff, and they couldn't cut. Now, something just to think about from this point of view. If the Fed cuts interest rates near an all-time high, They've done that twice so far this year, back in September and then on October 28th. And
Okay.
they might next week. We found 21 times where the Fed cut interest rates, Todd, within 2% of all-time high. The S&P 500 a year later is higher 21 times. Every single time the S&P is higher a year later if they cut near all-time highs. So there is that saying, don't fight the Fed. The
Yeah.
economy is strong. Yes. Are there cracks? Yes. We still think a couple more cuts make sense. I mean, where's the economy weak? The housing market, small businesses, some of the areas that are really impacted by higher interest rates. So it's a tough situation. I mean, I get it. There's a reason nobody's too sure about all this stuff. But we still think a couple cuts make sense. And last comment, who's in charge of the Fed? Jerome Powell. For how much longer? Through May. Well, by the time people listen to this, Kevin Hassett sounds like he's the odds-on favorite to maybe be announced as the next Fed chairperson. I don't know when it's going to happen, but that's what's being out there. He's dovish, right? I mean, we know that. So you're going to have more of a dovish Fed next year. So there's probably going to be 3 or 4 more cuts next year. Could the Fed, what's a big worry? Maybe inflation starts to creep up. The economy starts to overheat. You start to actually see a better, stronger economy. Now, that's maybe a good problem to have if we get there. But the reality is, again, that's kind of how we see it. More cuts are coming, and that's how we're positioning our portfolios.
So 2026, what are you telling the Carson clients? I mean,
Hmm.
is it
Yeah,
going to be better? Are we expecting the same or any type of challenges that investors need to be considering
sure.
next year?
Yeah, we haven't really officially released our outlook, but I can say this: we still remain overweight equities. We still look at having a diversified bucket, specifically developed international in some of those areas. You know, the thing to think about. The S&P was up 20% 2 years in a row. We don't know where this year is going to be, up ballpark 15. Maybe we don't quite get to 20. Your average year, if you don't have a recession, is up double digits like 7 out of 10 times. All right. I mean, so maybe we
Wow.
don't gain 20% next year. I don't think we will. But to think we can have another low double digit year if we can avoid a recession like we think we can, Todd, that makes sense to us to continue to expect this bull market to continue. Now, volatility is the toll we pay to invest. We say that a lot. I just recorded Facts versus Feelings, my weekly podcast I do with Schoenberger Geese on our team. And one of the things we're kicking around, what's Jerome Powell's legacy going to be? We don't know. You don't usually know someone's legacy until well after the fact. Well, we have a Fed now that actually has dissensions, right? I mean, for years, it was everyone agreed. Let's cut, let's not cut. Let's cut, let's not cut. That's fine, whatever. But Powell seems to really be pushing to have dissensions. I think that's great. I think it's good. You got 12 voting members. What are the odds 12 people in our country agree on anything? I mean, it's not very good, especially economic policy. So I think
Yeah.
he's creating a Fed that we haven't seen since I guess, 94 or so with more dissensions. And maybe he's doing that to kind of take some the pressure off the Fed to have more dissensions. So maybe all these cuts President Trump wants for when he puts his guy in play, he's not going to be so easy to do. I don't know the answer to this. These are things we're kicking around thinking about. But I think the fact we're going to have more dissensions is maybe a good thing. And we have some checks and balances, not just everyone who's a yes man to whatever, 1 or 2 people at the top of the Fed want. I think that's a positive thing at the end of the day.
Yeah, I agree with that. The checks and balances within the Fed, and it's something that I think had been missing, but you
Hmm.
hear it now. So, with that said, though, going into the 2026, and I think investors are really they love the optimism for the year-end rally, but what happens next year? And
Hmm.
so there is that looming cloud of tariffs. Do
Yeah.
you see that impacting at all? Because we haven't, it seems that tariffs have been, I hate to say it, but they have been in check, though. I mean, do you
Hmm.
think that that is just a ticking time bomb, perhaps for next year?
No, we don't. I don't think anyone wants to go back to Liberation Day. And you look at what
Okay.
President Trump and different people are doing. They're kind of taking some of these tariffs off. The effective tariff rate right now, at least as of the end of the month, last month, is like 12%, right? It was like
Okay.
3, 4% at the start of the year. We assumed it'd be probably around 10 to 12% when President Trump won. That's why when he held up that piece of paper, on Liberation Day that said effective tariff rate of 25, 26%, that's why the
Right.
market was down 10.5% in 2 days, freaked everybody out. But now here we are kind of back to that area. Now, one other thing to think about here that's interesting, if you go back in history and look, when you have a new Fed chairperson, you know what happens? The market tends to test them. The market tends to be kind of weak. I don't know if it's random or not, but I do know, when Jerome Powell took over, when did he take over? February 4th of 2018. 2019. Go back on the history books and look. We had like Volmageddon back then. The market really had a lot of volatility and a big sell-off. 1987, what happened? August of 87, all 6'7" Paul Volcker said, "Here, Greenspan, you're it." That was a handoff right before a major crash. And there are some other examples. It's also a midterm year, and everybody's going to hear a lot about this. I've been sharing the data too. Midterm years are the most volatile. From a peak to trough, so from the max to the bottom, midterm years pull back 17% on average. That's the most out of a 4-year cycle. So just know that some of these things are out there. There's some more volatility, but we are in a world lately, and I think we're still in it, where you go down quickly, but you come back up just as quickly. So if we have some volatility, a well-deserved 15% pullback peak to trough next year, which I think is quite possible, honestly, don't panic. Look at the data, look at the fundamentals, and if things are still solid, it's probably more of an opportunity than not for, again, more longer-term investors.
Yeah, that's amazing knowledge. I know the audience loves that.
I just make it all up. I'm not sure if it's true. I don't know.
It's definitely true. If you guys are doing it and you're publishing it, I know it's true. Yeah. So what is your favorite theme for 2026?
Yeah, well, gee, that's a great one. I mean, I think I'll give. Hey, are we amongst friends? We amongst friends here?
Yeah. The ball.
Yeah. No one's listening, right? Just you and I. The theme to our 2026 outlook is ride the wave. So you think about what that says to us. Again, like I've talked about, if you're riding a wave, right? It's great. I mean, you might go a lot further than you think. It's going to be fun. It's going to be fast. But what if you hit some bubbles, or not bubbles? What if you hit some rockiness? What if you fall? That's the scary part of riding a wave. And as we head into next year, we think riding the wave makes sense. You still want to be overweight equities. You still want to have a globally diversified bucket out there. You still want to own some bonds and some gold and some futures and some cash. Yes. But you still want to ride this wave that we think, again, has more time. One more thing on this. I've talked a lot about this, but listeners might like it. This bull market just turned 3 years old last October, at October 12th, 2022, into that bear market. Just turned 3 years old. Todd, it's fascinating. When you look in history, the average bull market lasts about 5 years. But if you look at the last 5 bull markets, the last 50 years that made it this far, the average was 8 years. The shortest was 5. The longest was like 12, and I think we had a 13 in there. So this bull market might seem old. But when you look back in history, this bull market's not nearly as old as you might think. And again, we're optimistic that this ride the wave scenario is there. And again, we manage a lot of money, and we look at this from a lot of different views. And we still think that there's still a lot of opportunity out there for investors. And then to put a bow on it, what's the Fed going to be next year? Probably more dovish than not. Look in history, when you have an economy that's fairly strong, with strong earnings, like we're probably going to see, with a dovish Fed, that's a pretty bullish elixir for investors. Maybe 27 things change. Maybe the second half of 26 things change. When they do, we'll talk about it. But for now, that's some reasons to think this bull market's alive and well.
That's amazing. Ryan, I've always considered you as one of the greatest pundits that's out there. You're in the financial press everywhere. You, Dr. Yardeni, Sam Stovall, the biggest pundits, the best ones are the ones that are most optimistic right now. And I think that's fabulous. There's a lot to be said with that. And but I do appreciate you joining me today on the Money Path. This was amazing. I wish your Cincinnati Bengals the best as well. And happy holidays, Ryan. But I do hope to have you back real soon.
Well, no, I appreciate it, Todd. I think you said I have a face for radio is what you said there, because they keep inviting me back. I don't know, but it's fun. I love talking about this stuff. And again, if people enjoy what I just said, I'd love you could check out Facts versus Feelings. And I'll be back whenever you want me. And I know there's lots to talk about next year, but everyone have a great holiday season and maybe ride the wave as we head into the rest of this year. But you can bring us home. Thank you, Todd. Absolutely, Ryan. So thank you so much. So on behalf of Ryan Detrick, I am Todd Schoenberger. Joining me on Friday is Jim Bianco, who's going to be joining me live at 11 a.m. You definitely want to hear what he has to say. So again, thank you, Ryan, and we'll catch you next time. Take care.
Access real-time data and intelligent analytics exactly when you need them. Get the right data at the right time. Learn more at quotemedia.com.